Hi everyone, so we're going to be covering financial instruments and how to measure them using the amortized cost model, okay? And for fun, I've put a picture of a trumpet because we're looking at instruments, ha ha ha, gosh I'm so funny, using novel techniques to engage people in my videos, wow. So what is a financial instrument? It's a piece of paper basically, at the end of the day. So it's an item arising as a result of a contractual relationship. So what do we include in that? Financial assets. So these are assets arising as a result of contracts. These can include cash. Okay, that's a piece of paper. Investments in shares and bonds. Okay, so where you're the investor. Trade receivables, invoices, long-term receivables. Okay. We also include in them financial liabilities, so which are arising as a result of contractual obligations. So that includes debentures, bonds. So from a liabilities perspective, you're the issuer of the bond. If you're trying to recognize an asset as a result of the bond, you have to be the bondholder, okay? So you're the one who's collecting the interest on the bond and who's being paid the principal amount. Okay, now convertible bonds we'll cover in another presentation, but they essentially have an equity and a loan component. Speaking of equity, equity also falls under the scope of financial instruments, and again, it's pieces of paper at the end of the day. We can have ordinary share capital, preference share capital. Okay, simple. In some cases, you might know, but preference share capital, if it's redeemable, i.e., you have to repay it back to the shareholders, we have to sometimes treat as a financial liability because it's why do we have to treat it as a financial liability? Because in substance, it's an in substance is a loan because we have to repay the share capital. Okay. Now, how do we measure how do you account for financial assets and financial liabilities? Okay. Now, for the purposes of this lecture, we're only going to really focus on bonds. Okay, so from a financial asset perspective, we purchased a bond with interest income. And from a liabilities perspective, the issuer of the bond is incurring interest on the bond. Okay, so for financial asset, we record at the fair value plus transaction costs. And transaction costs are the costs associated with buying the instrument, like broker fees. Liabilities perspective, you do the opposite, so you do fair value less transaction costs. And then for subsequent measurement, we measure them at generally measure them at amortized cost. Sometimes you can measure assets or liabilities at fair value, but for the purposes of this presentation, we're going to only look at amortized costs because the other ones are outside of our scope. We generally de-recognize obviously assets and liabilities if we sold them to other parties or the contracts have been fulfilled from both sides of the party. Okay. So what does amortized costs mean? We've seen that phrase come up. Well, the way to think about it is we have the initial carrying amount, which is either the fair value plus transaction costs or the fair value minus transaction costs. You add on interest expense or income calculated at the effective interest rate. Okay, effective interest rate I'll be explaining on the next slide, but this part hits our profit and loss statement. It either increases our profit or decreases the profit. We then take away any repayments of interest and repayments of the principal amount. Okay, so this is adding and this is taking away. We also add on foreign exchange gain or loss if the instrument is in a foreign currency. And that's the last thing we would do. Now, points 2 and 3, the order depends on whether the interest is paid in arrears or paid in advance. Okay, but we'll cover that later on. So what is the effective interest rate? Well, consider this example. It's basically the hidden cost of using a loan. Okay, so it's sort of imaginary. So imagine that I'm loaned 100k, I borrow 100k, but I have to repay 110k at the end of 1 year. Okay, so I'm repaying it at a premium. There are no interest payments or coupon payments. Okay, so another word for saying interest payments are coupon payments. So the coupon rate is 0%, right? So let's think of this situation. If I've what's my final balance in my loan account going to be if I keep the accounting really simple? Well, it's going to be 100 minus 110k. So I'm getting a negative value of 10k, which basically means I'm owed money. So I've got a debtor balance of 10k. Does that make sense? No, because I don't actually have to. I'm not going to receive that 10k from the lender, am I? I'm not going to receive that additional 10k ever. So it doesn't make sense to record it as a debtor. But instead, we record the difference as 10k. So the 110k is payable at the end of the year. So the charge per year is 10k. Okay, so I kept it simple. I've used it said at the end of 1 year. It'll be a bit different if we said at the end of 3 years. Okay, so the actual interest charge is 10k. So the effective interest rate is 10k divided by the 100k, which gives us 10%. So even though we're not paying any interest, there is actually an interest charge of 10%. Okay, and I just want to point out that normally you get the effective interest rate will differ from the percentage payment you're making if the amount you're borrowing is different from the amount you have to repay. Okay, and the point of the effective interest rate is that it ensures that the balance at the end of the terms of the loan comes down to zero, so your liability is zero at the end of the period. Okay, and as Monty Panis, our legendary off-spin bowler, is going to tell us, you're told the effective interest rate in the exam. Okay, so you never have to recalculate it in the exam. Now let's go for an example of how to calculate final balance using the amortized cost model. So in this example, imagine that I'm issued 100k of bonds at a coupon rate of 3% per annum, payable in arrears, so at the end of the year, where the effective interest rate is 4%. Okay, so I issue these bonds at 1st of January 22, so right at the beginning of the year, and they're expected to be redeemed at a premium in several years' time. What is the final balance as at 31st of December 22? Well, what do we do first? We put in our initial balance of 100k. I haven't put in any transaction fees. I didn't want to complicate it any further. Now, what's going to happen first? The incurring of the interest charge or the coupon payments. Well, it's going to be the incurring of the interest charge, isn't it? Because the 3% is payable in arrears. Okay, so effective interest rate comes before the coupon payment if it's arrears. So how do we calculate this effective interest? Well, we do 4% times 100, and that gives us 4. What's my coupon payment going to be? Well, the coupon payment is always the same. It's always going to be 3% of 100, and that's going to give you minus 3. What's my carried forward going to be? It's going to be the 100 plus the 4 minus the 3, and that gives me 101. Okay. Now let's carry this on for another line, another year. So we start off this time with 101. Okay. How do I calculate the effective interest rate here? How do I calculate the effective interest here? Well, I do 4% times 101, and that gives me 4.04. So I put that in. What's my coupon payment going to be here? Again, it's going to be minus 3. So then I'm left with a carrying balance of 101 plus 4.04 minus 3, and that gives me 102.04. Okay, so it's actually gone up in value. Now, one way of getting an additional mark in the exam is understanding what portion of the bond sits in current liability and what portion sits in non-current. Okay, now in this case the 101 sits in non-current. Okay, because what we're doing is we're adding interest on top of the 101, and that interest is independent. Okay, and then the 3 happens later. Okay, so in this case, very simple, we classify the whole 101 under non-current liabilities. Okay, because technically we're not paying any interest in relation specifically to this 101 in the year, next year I mean. Okay, now we need to understand what the double entries are for the effective interest rate and the coupon payments. Okay, and this helped me understand it fully when I understood the double entries. Now for this 4, we do debit finance costs, credit financial liabilities. Okay, so it's hitting our P&L, and what it's doing is it's reducing our profit by 4k. What's happening with this 3k? Well, we're actually making these payments, so we're crediting cash, and the debit is going to financial liability. Okay, so credit cash, debit financial liability. So the net movement in our liability is going to be 4 minus 3, which gives us 1. Okay, seems fairly simple, no? So this is hitting our bank statement, you could say. The coupon is hitting our bank statement, but the effective interest rate is hitting our P&L. Right, let's now cover another example, but this time I make payments in advance. So I pay interest in advance, but everything is the same except the payments in advance. So I'm still issuing 100k, I'm still redeeming at more than 100k. The coupon rate is still 3% per annum, and the effective interest rate is 4%. Okay, so how do I actually do it this time round? Well, this time we're doing the coupon payments in advance, so brought forward, you can actually adjust it immediately. You can do 100k minus the 3k gives us 97k. Okay, so then we're accumulating interest on the 97. So how do we do that? Well, we calculate 4% of 97, and that gives us 3.88. And then our final balance is going to be 100.88. Okay, so because we're doing 98 plus 3.88 gives us 100.88. And I've put the total liability here. Now, what do we start off with? Well, we start for the next year. Well, we start off with 100.88, as always. What's my coupon payment going to be here? Again, it's going to be the 3% times the 100, and that gives me minus 3. What's my adjusted balance going to be? Yeah, it's going to be 97.88. So this time round, we've actually made a coupon payment from the 100.88, from the liability at the end of the year. So this 3 is our current liability. But then this 97.88 becomes a non-current liability, so it's a balancing figure. What do we have next? Well, to finish off this line, let's finish it off completely, like a soldier. So we do 4% times 97.88, and that gives us 3.92. And then we have a balance of 101.8. Now, we don't include the 3.2 in the total liability at the end of the year because we haven't actually incurred it yet, and it doesn't make sense to include it because our 97.88 and the 3k already adds up to 100.88. Okay, so you can either learn this pro forma, both pro formas, so that you know what to do in each situation. Okay, so just to summarize the double entries, because I think it's important, remember, effective interest rate hits our profit and loss statement, and the coupon payments hit our bank statement. Okay, so one side is always going to liability or receivable or financial asset. For the effective interest rate, it's always going to be debit expense or credit income. For the coupon payment, it's always going to be credit cash or debit cash. The coupon payment is a balance sheet movement, and the effective interest rate movement is always a P&L movement. Okay. So remember, financial liability, we do fair value minus transaction costs, and then for the financial asset, we do the opposite. We do fair value plus transaction costs. Okay. Hope that was useful, and as always, let me know how you found that. Okay, thanks everybody. Cheers. Bye.